How is the defeasance carried out? How are you able to make it possible?
Sure. So imagine a $10 million loan with 2 years left on it. We calculate a prepayment penalty at just a handful of percent. But instead of creating just a traditional payoff letter that the bank says you need to wire us these funds, we structure a bond portfolio that replicates the remainder of the cash flow. So if it's a $50,000 a month debt service payment to Wells Fargo, a bond matures each month leading up to that, along with the final balloon payment at maturity.
Hey, everybody. Thanks for coming on for today. About 2 weeks ago, I really wanted to get more knowledge on what defeasance was, particularly in the multifamily field. I did a post on LinkedIn and said, hey, who's the expert in defeasance? And got several responses about Scott Burnett. Scott Burnett is with Defease with Ease. He's been in this business for almost 20 years. All they do is defeasance. And so the people who were recommending Scott, thank you, definitely have the right person.
For people that aren't familiar with it, it's basically a form of prepayment. It's a style of prepayment preferred by capital markets groups, Freddie Mac, other institutions. Instead of taking a cash prepayment, it's basically a substitution of collateral where we structure a securities portfolio, a different type of security instrument that yields all of the remaining returns back to the investors. From a borrower standpoint, it's a prepayment option. That's the easiest way to look at it. There's an arbitrary calculation similar to like you would get in a yield maintenance or some other form of prepayment. We're here to provide all of the upfront analytics, evaluating your particular properties, your loans, your portfolios, whatever it ends up being.
In order to drive this alternative option home, defeasance, maybe give one or two examples of ways you've helped folks.
When you have a live scenario, what is defeasance? And there is a prepayment methodology. And essentially in today's high rate environment, that prepayment cost is virtually zero now. Defeasance was always seen as an event that was hard to overcome.
Explain why that is, please. Explain why that is.
Yeah. So in any prepayment scenario, unlike our cars, our houses that are basically just prepayable at par at any point with no interest cost at any point. So with defeasance or even yield maintenance, basically there's an interest differential. If the coupon on your existing note is 4.5%, in the old days of yield maintenance when rates were only at 1%, there's a formula that would come into play and go, well, the servicer wants to get basically the full return on their interest for the life of the loan. They're going to come up with a calculation that says there's a 3% difference for the next 5 years. So there's a 15% penalty. That's a number that a seller has to try to overcome.
And correct me if I'm wrong, when you get a loan from a lender to buy an apartment complex, 100 units, whatever it is, that lender has lent you at a certain interest rate and they want to earn that interest rate. If a couple years down the road, you're in an interest rate environment that is much less than that, and you want to pay off the loan, they're now going to leave, call it a 4.5% income to them as a bank and the investors who invest in that bank. And now you're making them have to loan out at 1% with those same funds. And so there's a penalty there. Like they've told their investors, I'm lending to this guy for 4%. We're going to get 4% for 7 years.
And it's guaranteed.
It's guaranteed. And now you're telling your lender, no, I want to sell it. And so there's going to be a penalty. That's where you guys come in.
Yeah, exactly. And I think that's the easiest way to look at it. Even though it is a collateral substitution, different than yield maintenance and substitution of cash flows and things of that nature, I think in its simplest form, people just need to understand that it's a prepayment methodology that's utilized. You arrive in the same place, and there's always generally a cost to do it because of the environment we're in today. Most of our borrowers are actually exiting out at virtually zero prepayment expense because the 2-year treasury is at 4.5%. So anything, especially if you look at originations over the last 5-6 years, we weren't originating loans at 5-6-7% like we did 10-12 years ago. These are all 3-4% coupons. But now what you're dealing with is now the cost of funds have now shifted the other way. So now the prepayment costs are low, cost of funds are high. So there's a balancing act there. But the focus of our group, not only from an execution and a transactional management standpoint for live deals, more importantly, that is just to provide long, short-term planning for all of our clients, whether it's a small, mom and pop who owns a self-storage facility to the largest REIT in North America, just so they can see what does it look like today. Because as for anyone who's been in the business, what we see today versus what is 6 months from now can be totally different. And we can stress a lot of the analytics so you can start getting out ahead of what we saw earlier this year that caught everyone by surprise. I think for the last 3 or 4 years, we've been harping on higher rates, higher rates, higher rates. And over time, we'd see 25, 50, 75. Well, we saw 300 basis points in a quarter. And that literally turned the whole industry upside down in a good and a bad way. It shot volume up. This is the most volume we've seen since '07, primarily because of fear of rates and then obviously liquidity in the market, values.
So on that note, at what point in the cycle, whether it's before they own it or during the ownership cycle, should someone reach out to your group?
I think generally speaking, at any point, if you have a loan that has any prepayment call protection, whether it's yield maintenance, defeasance, we're happy to take a look at that. All of our front end analytics are free of charge. It's what we do all day long. There's 20 people here in the Charlotte office that do nothing but evaluate loan documents, provide all of the future scenarios and cost breakdowns. We have a calculator on our website as well that you can just do it on your own. Even if you're unsure of whether you're going to transact, we can model it up, show you what it looks like today, 12 months from now. Never too soon. I can tell you that. A lot of times it ends up being too late, more often than too soon. So even if you're not looking to transact ever, a lot of people think they're going to hold these loans for, all the way to the open period 10 years later. Well, lo and behold, our industry changes, the economics change. You get an unforeseen buyer that comes out of nowhere, and you just need to be equipped with what the costs look like.
It almost sounds like if you own multifamily, there's nothing wrong with every 6 to 12 months, whether you were thinking about selling or paying it off anyway, is just checking in with you guys. It sounds like it's free in the meantime. It's when they need to execute upon that where your fee structure comes in.
Well, exactly. Like I tell people, I may talk to you for 10 years and you never have to transact on any of your defeasance loans. And that's not great for us, but it's one of those things where that's why we're here. There's enough loans being defeased that we provide the back office applications. So you always have an idea of where you are.
So tell me high level, without losing a bunch of people and needing a spreadsheet, how is the defeasance carried out? How are you able to make it possible?
Sure. So imagine a $10 million loan with 2 years left on it. We calculate a prepayment penalty at just a handful of percent. But instead of creating just a traditional payoff letter that the bank says you need to wire us these funds, we structure a bond portfolio that replicates the remainder of the cash flow. So if it's a $50,000 a month debt service payment to Wells Fargo, a bond matures each month leading up to that, along with the final balloon payment at maturity. When we go through the defeasance, the current borrower structure, the LLC, the LP, whatever it ends up being, is released from their obligations via the sale or refinance. This bond portfolio now is basically the collateral under the note. It's a self-liquidating portfolio. It sits in a trust account and makes those payments in a timely fashion. But the key is the borrower's release. There's no trailing obligations in any capacity, whether they're selling or refinancing. So you really arrive at the same place as you would in a payoff event. There's some legal requirements because of the collateral swap and the loan assignment. Without getting too detailed in that, that's really our role, is to bring all of those parties together. We're kind of the last piece of the puzzle in the real estate transaction, looking at it as a true payoff event. Like I tell people, that's the only way for you to look at it. Let me handle all the nuances and some of the legal centric items that your counsel's probably going to have to do. But at the end of the day, you're going to arrive with a property unencumbered, much like you would in any payoff event.
And so is the borrower using funds from closing to fund that alternative investment that throws off the interest that makes the lender satisfied?
Generally speaking, yes. I would say 99% of the time, most people don't have enough cash sitting around to pay it off. And that also, there is a coordination of efforts here, unlike a yield maintenance where a payoff may be good for 5 or 10 days. We need certainty of closing. I'm buying a bond portfolio over 2 days, coordinating around that sale or refinance. So again, that's really probably the toughest part of our job, is to coordinate those efforts to ensure the borrower is not exposed to failed securities settlement. But no, we are going to use the title company, the escrow agent. There's an escrow letter and everything else that kind of piggybacks on everything, much like any normal payoff event with your regional bank.
How is your fee structured with the borrower?
Yeah, so when we analyze anyone's loan, most of the third parties in our entire transaction, it's a fixed fee, pre-negotiated on the front end. Generally speaking, ours is in the $10,000 to $15,000 range. It's a per fee. It's not a percentage. The other host of third parties are going to have a range of fees based on the term to maturity, the complexity of the deal. I would say third party costs are in the $50,000 to $60,000 range on every transaction, whether it's a $1 million transaction to a $400 million.
What's the main tip you would give those listening today? I mean, it sounds to me like it doesn't hurt them to just plug in with you.
The more legwork you can do on the front end to just have an idea of what that looks like out in the future, so it's just not a surprise when you do get a call from a buyer, or all of a sudden you start to see the run on rates and now you're already behind the 8 ball because you've lost 300 basis points in the market.
All right, let's end with this. How can folks reach you?
Okay, easiest way to reach me, Burnett at defeasewithEase.com. Easiest way to also go to our website, defeasewithEase.com, 704-578-3500. I'll share my information, obviously, with Beau here, and I certainly appreciate the opportunity to chat with everyone. Hopefully, just like Beau's been a resource for everyone for the last period of time. And again, we're all in this together. We're all trying to make transactions happen, whether I'm a part of them or not. So I appreciate the time today.